Rising interest rates have always unsettled investors. They shake valuations, slow economies, and test conviction. Each time they climb, headlines declare the end of the bull market, and investors rush to ask the same anxious question: what should I do now? But Benjamin Graham would have told us that the real question isn't what to do, it's how to think. Because when interest rates rise, what truly determines success isn't timing the next move, but understanding the timeless principles that make markets behave the way they do. In this episode, we'll explore how to use Graham's framework when interest rates rise, not as a forecasting tool, but as a guide to rational decision-making. You'll see how Graham's core ideas, intrinsic value, margin of safety, and investor temperament become even more vital when the cost of money itself begins to change. Nearly a century after he wrote The Intelligent Investor, his method remains a compass for moments like this, when most investors feel lost. So by the end of this video, you'll understand not only how Graham thought about changing interest rates, but also how you can apply that same discipline in today's unpredictable market environment. Because while interest rates may rise and fall, rational investing endures. To understand how Graham's framework can guide us through rising interest rates, we must first step back into his world, a time when the financial landscape shifted beneath investors' feet just as dramatically as it does today. Benjamin Graham began his career in the roaring 1920s, an age of prosperity fueled by easy credit and speculative enthusiasm. Interest rates were low, optimism was high, and few could imagine the crash that was about to come. When the Great Depression struck, interest rates collapsed to near zero, but asset values collapsed even faster. Graham watched fortunes evaporate, not because people lacked intelligence, but because they lacked discipline. Then, in the years that followed, the cycle turned again. As the U.S. emerged from World War II, inflation surged, governments tightened monetary policy, and interest rates began their long post-war climb. Bonds that once seemed safe fell sharply in price. Stock valuations contracted. And once again, investors were caught off guard, believing that what worked in one era of rates would automatically work in another. Through these turbulent decades, Graham developed a worldview that was neither optimistic nor pessimistic, but deeply rational. He understood that markets move in cycles, and that interest rates, like emotions, swing from extremes of complacency to extremes of fear. To Graham, this was not a reason for panic, it was a reason for preparation. He taught that the intelligent investor should never build a strategy on the assumption that conditions will remain favorable. Instead, he should design it to survive and thrive under unfavorable ones. And rising interest rates, he believed, were precisely such a test. In that environment, the market begins to distinguish between what is speculative hope and what is demonstrable value. And that, Graham would say, is when the true investor has his greatest advantage, because when money becomes more expensive, reason becomes more valuable. To Benjamin Graham, value was never an abstract concept. It was always rooted in measurable reality, in the tangible relationship between what you pay and what you get in return. Interest rates, in that sense, are not just numbers on a chart. They are the invisible gravity of the financial universe, quietly determining what every asset is worth. When rates are low, gravity weakens. Investors begin to believe that every future dollar, no matter how distant, is almost as valuable as one today. That belief inflates valuations, encourages speculation, and blurs the line between price and value. But when rates rise, gravity returns. The future becomes more expensive. Speculation slows, valuations compress, and markets begin to rediscover discipline.
Graham understood this long before the models of modern finance attempted to formalize it. He saw that a change in interest rates does not just affect bonds, it changes the psychology of the entire market. When the cost of money rises, the tolerance for risk declines. Investors demand proof, not promises. They demand real earnings, not projections. And this, in Graham's eyes, was a healthy process, a cleansing one. He would say that rising rates are not the enemy of the intelligent investor, they are the enemy of the careless one. Because the intelligent investor, grounded in analysis and margin of safety, welcomes any environment that exposes illusion. And nothing does that more swiftly than the quiet pressure of higher rates. For Graham, the relationship between rates and value was therefore not mechanical, it was philosophical. It was a reminder that markets are always testing our assumptions. When conditions change, what truly has value must stand on its own, without the help of cheap money or collective enthusiasm. Benjamin Graham approached interest rates not as a forecaster, but as a realist. He knew he could not predict where rates would go, but he could prepare for what their movement meant. In Security Analysis and later in The Intelligent Investor, Graham outlined a principle that guided his thinking through both high-rate and low-rate environments. Investing decisions must always be grounded in a margin of safety, one that widens as uncertainty grows. When rates were low, Graham warned that valuations tend to stretch beyond reason. Investors grow complacent. Discount rates fall, and the appetite for risk expands far faster than earnings can justify. He would respond not by chasing the trend, but by tightening his discipline, demanding more tangible proof of value, more conservative assumptions, and wider margins of safety. Conversely, when rates rose and the market turned fearful, Graham saw opportunity. Higher yields meant more reasonable stock prices, greater prospective returns, and the reappearance of genuine bargains. But even then, he resisted haste. His method was not to buy simply because prices fell, but to buy only when the price fell below conservatively estimated value. He often described this as an intellectual posture rather than a formula. Instead of adjusting his models to match the market, he adjusted his expectations to match reality. He accepted that intrinsic value, though stable in theory, is always influenced by the environment in which capital must operate. In practical terms, this meant revisiting assumptions, not abandoning them. When bond yields rose, Graham would use those higher rates as his new yardstick for required return. When they fell, he refused to lower his standards simply to justify higher prices. He often reminded students and investors alike, obvious prospects for physical growth in a business do not translate into obvious profits for investors. And in a rising rate world, that reminder becomes especially important, because while most investors see higher rates as a threat, Graham saw them as a filter, a tool that separates the sound from the speculative. He adjusted by anchoring himself even more firmly to his principles. Insist on tangible value. Reevaluate assumptions about earnings and growth. Compare every investment not to the past, but to the current reality of returns elsewhere. Graham's method, in short, was not to fight the tide, but to let it reveal what is truly anchored. Nearly a century after Security Analysis, we find ourselves in a world that Graham would recognize, not in its technology, but in its temperament. For more than a decade, investors lived in an era of near-zero interest rates. It was a period where risk seemed almost free, and patience felt unnecessary. Capital flowed into growth stories, profitless innovation, and narratives built on the assumption that money would always be cheap.
But as rates began to rise, quietly at first, then suddenly and sharply, that illusion cracked. Valuations that once seemed rational began to shrink. Companies that had been rewarded for expansion at any cost found themselves struggling under the weight of debt and slowing growth. If Graham were alive today, he would not be surprised. He would say, the tide is merely revealing who confused liquidity for value. His framework offers a timeless lens through which to interpret this shift. In rising rate environments, the intelligent investor does three things. First, he recalibrates expectations. When risk-free returns, such as treasury yields, rise, the return demanded from every other investment must rise as well. What once seemed like a fair price for a stock may now be excessive. Graham would remind us, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. If that satisfactory return is no longer satisfactory compared to safer alternatives, the rational investor must reassess. Second, he seeks the neglected. Periods of adjustment often bring indiscriminate selling. Quality companies, especially those with durable earnings and strong balance sheets, get punished alongside the speculative. This is the fertile ground Graham described, the place where emotion creates opportunity. Third, he protects against illusion. In the noise of rate-driven fear, investors may rush either to extremes, hoarding cash or chasing yield. Graham would counsel balance. The goal is not to time rates, but to maintain reason when others lose it. He might look at today's market, where some lament the death of growth, while others proclaim a new era of inflation-proof assets, and quietly smile. Because both are reactions, not analysis. And for Graham, reaction was the enemy of reason. In truth, the rising rate environment of today is simply another test, one that reveals who among us truly understands value and who has been carried by momentum. And in that test, Graham's framework becomes more than historical wisdom. It becomes a compass, guiding the investor back toward the principles that never change, even when everything else does. When interest rates rise, something deeper happens than a shift in the yield curve. What truly changes is not the mathematics of finance, but the psychology of investors. Graham understood this. He knew that the greatest danger in markets was not volatility, but vanity, the quiet confidence that our recent success is proof of enduring skill. Low interest rates feed that illusion. They make even poor decisions look wise. They allow speculation to masquerade as strategy. They reward the impatient and silence the cautious. But when rates rise, the illusion fades. Suddenly, reality demands discipline. The market, in Graham's words, stops being a voting machine and once again becomes a weighing machine. And yet, the pain investors feel in such moments is not caused by interest rates themselves. It's caused by the loss of illusion. We suffer not because value disappears, but because confidence was misplaced. This is why Graham often reminded investors that the function of the market is to serve you, not to instruct you. When rates rise and prices fall, most people interpret the market's decline as disapproval, but Graham saw it differently, as an invitation to think, to measure, to judge independently. In this way, the rise and fall of rates mirrors the cycles of human emotion. When money is cheap, humility is rare. When money grows costly, wisdom returns. Rising rates remind us of something profoundly human, our tendency to mistake the conditions of the moment for the laws of nature. We act as though low rates will last forever, until they don't. And when they change, we behave as though the world itself has shifted, rather than realizing it is we who must adjust.
Graham's philosophy invites a different kind of reaction, or rather, the absence of reaction. He would have us step back and observe the pattern, not participate in the panic. He would ask, if intrinsic value depends on future earnings discounted to the present, has the business itself changed, or only the discount rate applied to it? That question strips away emotion and restores perspective. It reveals that most of what disturbs investors is not new information, but old truths rediscovered. For the intelligent investor, rising rates are not a reason for fear, but a reminder of balance. They remind us that the foundation of value must always rest on something sturdier than sentiment. That even in a shifting world, discipline endures. Because ultimately, as Graham taught, the true enemy of the investor is not inflation or interest rates. It is impatience. So what does all this mean for us, the modern investor, navigating a world where interest rates are once again uncertain, volatile, and politically charged? Benjamin Graham would remind us that the intelligent investor is not a prophet of the future, but a student of the present. The question is not where rates are going, but how we should think when they change. When interest rates rise, Graham's framework suggests 3 timeless disciplines. First, recalibrate your expectations, not your emotions. Accept that higher rates will compress valuations and slow speculative gains. That isn't misfortune, it's reality. It restores balance to markets that have drifted too far from reason. Graham would say, if you understand that value is anchored in what a business earns, not what investors imagine, then a shift in interest rates doesn't threaten your philosophy. It clarifies it. Second, rebuild your margin of safety. Higher rates widen the gap between perception and value. They test which companies can thrive when capital is no longer free. This is when Graham's favorite phrase, the margin of safety, regains its full meaning. Buy not because prices have fallen, but because values now exceed prices by a margin that protects you from error. Third, return to fundamentals. In every rate cycle, speculation eventually exhausts itself, and reason quietly reclaims its place. Cash flow, balance sheets, and dividends, the things that seemed dull during the easy money years, become the anchors of survival. Graham's wisdom, then, is not a reaction to interest rates, but an antidote to how we react to them. It is the discipline to think in principles when others think in predictions. And so, when you hear the noise, when headlines scream about yield curves and pivot points, remember what Graham taught. The intelligent investor is one who sells to optimists and buys from pessimists. In a rising rate world, pessimism grows abundant, and opportunity quietly returns. Because in truth, the intelligent investor's compass never changes. It always points to the same coordinates. Value over price. Reason over reaction. Discipline over drama. To Graham, rising rates were not a threat to wealth. They were a test of character. And for those willing to think independently, to measure value rather than emotion, and to hold faith in logic when others lose it, every market cycle, even the painful ones, offers not fear, but freedom. A freedom that comes from understanding, as Graham did, that investing wisely has never been about predicting the future, but about preparing for it. Pause. Reflect. Think like Graham. And remember, subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.